which has been one of Josh's favorite names, but nonetheless, I'll give him the question to you, and maybe he can react to that too.
Hey, Brad, I want to go back to Snowflake, which you mentioned is one of the names you're most bullish on. This is a stock that had a market value of $160 billion last fall, and now it's about $54 billion. It was a price to sales forward 73. Now it's 27. If you're owning it at both of those valuations, aren't you kind of saying de facto, I don't care about valuations. I think the growth will be more than enough to overwhelm those, no matter how expensive I'm in this stock at? Like, give us an answer, like, as far as like how you're thinking about a company like that, because there are many stocks that this would be apropos of.
Right, you're exactly right, Josh, and it's loud here, but I'm tuning in. On Snowflake, the fact of the matter is, as I said to Scott last October, November, December, we had a lot of growth hedges in place, to help hedge out some of the risk in those positions. And so it's not fair to just look at a 13F and say that's the economic exposure, as you well know. So for those playing at home, our exposure did change over that period. We distributed to our LPs over $6 billion worth of Snowflake stock last year. And so, it's not as though we did nothing in the face of these high multiples. At the same time, we have extreme confidence that Snowflake is going to revisit those prices in the years ahead. I like to think about it not as a multiple of 1 year sales, but let's think about, what they're doing this year from a free cash flow perspective. They're going to have 15% free cash flow margins this year at nearly 100% revenue growth. They said they're going to take their free cash flow margin target significantly higher at their investor day later this year. We think that will be 30 to 40% in the fullness of time. And so, yes, that multiple, like all multiples, were too high in October and November. I was very open about talking about that. But when I look at the valuation today, please don't look at a 1 year forward sales number. It's highly misleading for a business that's growing at 70, 80, 90%, particularly when they're generating free cash. It would be one thing if they had an unproven business model and they were spending hundreds of millions of dollars a quarter, burning hundreds of millions of dollars a quarter in order to generate that top line. In Q4 alone, they signed $1.4 billion in annual contract value. That's as much as their total revenue last year. And so we think this is one of the biggest beneficiaries of the shift of all data workloads into the cloud. And that's why it's the biggest position in our portfolio. We still like CrowdStrike. We still like some of those other software names you mentioned, but we're consolidating at these prices into our better ideas.
Lastly, I got to let you go. Steve Weiss photobombed you in the back as you were on with us, as typical Weiss fashion would have it. CrowdStrike. I know I joked about it, but why did you get out? Because Josh is in, and he's talked about it a lot on this show.
Well, listen, CrowdStrike's been an excellent performer this year, a lot over the security fears associated with the war in Ukraine, et cetera. And so as a portfolio manager, I just have to look at the things that have been hit harder, that we like, maybe even a little bit more on the margin. And we rotate dollars into those things. We think it's a great business. It will continue to grow, but we just had a better idea. And while we're on the topic, Josh started the segment, I think, by talking about travel stocks. We know a thing or two, as you know, about travel stocks. What I would tell you is Peter and Expedia had an incredible print today. But the problem for the travel stocks is they've outperformed largely all other internet stocks. And so if you look at the multiple on Expedia or the multiple on Booking, it tends to be higher than the multiple on, say, something like Facebook. And so I think what you see today is people just giving back those things because they're trading at higher multiples on EBITDA or free cash than a lot of the other stuff in the internet sector.
I so much appreciate your time. You're a fave of our viewers. Can't thank you enough for making time for us, especially a good amount of it. I know you're busy out there. Brad Gerstner, we'll talk to you soon. That's Brad Gerstner, Altimeter Capital. We'll take a quick break with the committee.